Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Alibaba's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Alibaba is a Chinese e-commerce, retail, internet, and technology company. It is the largest company in China. It has three main websites: Taobao.com, Tmall.com, and Alibaba.com. Their biggest is Taobao.com, which offers customer-to-customer services where individuals or businesses can sell items on the site. It is very similar to eBay, where it acts as an intermediary between buyers and sellers. It does not warehouse products and deliver them like Amazon does. It is the 8th most visited website in the world. Amazon is ranked 11th. Tmall.com offers business-to-customer services. Only the brand owner or authorized dealer can operate a Tmall store. For example, Tencent may use Tmall to sell its products, not people like me and you. We can only buy products on Tmall, we can't sell them. Alibaba.com is one of the world's largest business-to-business marketplaces. Any company can sell on Alibaba.com, not just Chinese companies. Most transactions are processed on their websites using Alipay. In 2019, Alipay processed $17 trillion in transactions, while PayPal processed $172 billion. Baba is one of the largest, most valuable brands in the world. It has a mind-boggling 1.2 billion active users on its different platforms. The company is headquartered in Hangzhou, China, and was founded in 1999. It trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Xetra, Vienna, Swiss, Buenos Aires, Hong Kong, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 480 billion market cap. They're trading at 177 a share, and they have 2.7 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So look how much free cash flow they have. $30 billion in 2020, $27 billion in 2021. It nearly doubled from 2018. Free cash flow is the cash that's remaining after paying all your expenses and investing back into your business to grow it. It's the cash that's left over for you, the investor. So it's theoretically your cash. So the company can pay you a dividend, buy back stock, but since they're in ultra growth mode, they're constantly reinvesting in their company and growing it, which they're obviously doing because they grew their revenue from 60 billion to 123 billion, which is almost unheard of. Growing your revenue from 1 million to 2 million is doable, but from 60 billion to 120 billion, you have to sell a lot of products to grow at that rate. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that also grew from 14 billion to 24 billion. This is the company's income statement. All their financials are in Chinese ones. I converted the numbers to US dollars on my Excel spreadsheet. A quick way to convert to US dollars is just to divide the numbers by 7. The top line is the revenue, the sales. Here's a breakdown of their revenue, and a bulk is from their commerce websites. This includes Baba's cut of the transaction fees, fees paid by the merchant to Baba, advertising on his platform. Also, businesses and individuals pay for keyword searches, so they appear higher when people search for certain things. About 8% of their revenue is from cloud computing. This is similar to Amazon Web Services. About 4% of their revenue is from digital media and entertainment. They have a video streaming app called Youku. It's similar to YouTube, but it's more dynamic. The user is a lot more involved than on YouTube, and it's the largest video streaming site in China. But it's more focused on TV and movies, while YouTube is more focused on short videos. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that doubled from 2019 to the trailing 12 months. Below that is their operating expenses and then their operating income. That peaked at $93 billion in 2020. It's $86 billion in the trailing 12 months. Here's a breakdown of their 2021 expenses according to their annual report. A bulk is from cost of revenue, $421 billion. These are the expenses associated with its mobile platform and websites, such as depreciation and maintenance expenses for its servers, computers, and call centers. They spend $57 billion in product development because they're always looking to come out with new products or improve their current products. $81 billion in sales and marketing, $55 billion in G&A expenses, and $12 billion in amortization. They have a little debt on their balance sheet, so they paid $4.6 billion of interest on their debt, which was lower than 2019 at $5.2 billion. But look how much interest they earned, $65 billion. This is all the money that's sitting in their accounts waiting to be paid to the merchants. When someone buys a product using Alipay, Baba probably doesn't give the money to the seller right away. It sits on it for a day or two and collects interest, and then gives the money to the seller. So you can see they make a ton of money sitting on those funds and collecting interest. About $8.5 billion US in the trailing 12 months. Earnings from equity interest is its earnings in its investments in other companies. So it earned nearly 13 billion wons. It is possible to lose money in the investments in other companies. If the company it's investing in reports a loss on its income statement, then Baba has to report a loss, as it did in 2020. But the company has a lot of net income every single year, 150 billion wons. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate a ton of cash flow, 215 billion wons. That's equivalent to 30 billion US. And they do spend a lot on CapEx, constantly improving their platform. Operating cash flow minus CapEx gives you your free cash flow. And they have tons of free cash flow remaining. So they're mainly using this money to invest back into their business and grow it, or hold the cash and wait to acquire another company. So they did pay down a lot of debt in 2019 and 20, but they added a lot of debt in 2021. They don't buy back too much stock, only 11 billion in 2019. They had 2.2 billion shares outstanding in 2014, and then it jumped way up in 2015, and then it's been growing but pretty steadily since then. In 2014 is when they started trading in the US, so that's probably why they added a lot of shares. This is the equity section of the balance sheet. They have 1 trillion of equity. They raised 400 billion from selling their business, and they profited 600 billion from running their business. Retained earnings is a sum of all your prior net incomes. And in the beginning, they had negative retained earnings, as most companies do as they're growing. But they wiped out that negative, and now they have a big positive, bigger than the additional paid-in capital. So they're doing great. Let's look at the capital structure. 156 billion of equity, 24 billion of debt. They're 87% equity, 13% debt. And look at their net debt, negative 53 billion. So they could pay off all the debt with the cash on their balance sheet and still have $53 billion of cash left over. Their WACC is 10%, which is the middle WACC on Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for. That's 763 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $663 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of $245. They're trading at $177, so they're trading at a 28% discount. It's a buy according to the model. The average analyst projects their revenue to grow 16%. I grew their revenue 16% a year for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers, and that comes out to 25%. So I multiplied the future revenue estimates by 25%. That's how I got my future free cash flows. Simply Wall Street is higher than me. They're at $287 a share, so they're saying the stock is 38% undervalued. 25 analysts priced this stock, and the average price target was $245. Here's the stock price the last 12 months. So it was over $300 a share, but like most Chinese stocks, the price went down pretty dramatically. I think just a few weeks ago it was down to $130 a share. It has come up since the bottom. But there's been a lot of concern with the Chinese government interfering with companies trying to get funding in the United States. Also, there's concern with the Chinese government breaking up Alibaba. And on top of that, there's the Evergrande fiasco, which is China's second largest real estate developer. And if they go bankrupt, that could result in a recession for China. But even though there's lots of concerns with the Chinese government interfering with Alibaba, I just don't think that's going to happen. This is the biggest and most important company in China. They supply the most jobs. They provide so much tax funding. Even though China is a communist country, they still want to make money and progress, which they have been doing really well the past few decades. They have a low beta 0.84, so the stock is less volatile than the market. It's gone down 42% in the past 52 weeks, while the S&P is up 31%. The 52-week low was 138, the high was 319. And the stock is trading below its 200-day moving average, but above its 50-day moving average. This is a really highly traded stock. Nearly 27 million shares are traded on average each day. The share price isn't low, so it's a really highly traded stock for such a high share price. Of the 2.7 billion shares outstanding, 1.9 billion are on float, 26% are held by institutions, and 2.5% of the shares are shorted. And look how many jobs this company supplies, 250,000 jobs. They supply more jobs than any corporation, and they're probably top 3 in China, because I imagine the government supplies more jobs than this company. The massive Japanese investment firm SoftBank, they own 25% of the stock, then Vanguard, Jack Ma, the founder and ex-CEO, BlackRock, and T. Rowe Price. Let's look at their financial ratios. They have a PE of 20, which is a little better than a market median. A company with so much growth, a PE of 20 is amazing. When a company's growth flattens, then you want a PE like 15 or below. But with a hyper-growth company, you're willing to pay 40, 50, or even 100 PE, and their PE is 20. That is just amazing. You'll see later when we compare their PE to the industry average how much better it is than the average in the industry. A really good price to sales ratio for the size of the company, and a really good price to book. They have a decent return on invested capital of 11%. They can cover their interest payments 19 times. They have a pretty good ROE at 15%. They have a good current ratio and quick ratio of 1.8. And they have a ton of cash on their balance sheet, nearly $500 billion. That's equivalent to 70 billion US dollars. So they're really well capitalized. They generated 27 billion of free cash flow in 2021. They have 44 billion of working capital. So they have $72 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 15 companies in the same industry as Baba. And Baba's price multiples are much better than average. PE of 20, average is 63. Price to sales of 3.9, the average is 6.5. And price to book of 3.1, the average is 15. Their current ratio is a little higher than average. ROE is double average. Much less debt than the average company. And they're a massive company, nearly $500 billion market cap. One of the largest in the world. So to summarize, I have them trading at a 28% discount. If this was a US native company, the market cap will be well over $1 trillion. But since it's in China, there's that added risk of the Chinese government. But I think this is a great long-term play. They're number one in their industry. And I think you'll be surprised with how lenient the Chinese government is with massive companies like this. Because they really need companies this size and this important to lead the way and make China the economic powerhouse they want it to be. The poverty in China was really severe. It still is in certain parts, but it's so much better than it was. But they still have a lot of work ahead, and it's such a big country, there's so many people, so there's no reason this company can't grow a lot more in the next 10-20 years. I ranked their free cash flows 8 out of 10, their revenue 10 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, You can become a member by clicking on the link in the description below. Thanks for watching.